This video will show you a simple Ichimoku day trading strategy that you can start implementing right away. I will show you how to use the Ichimoku indicator, interpret it correctly, and a step-by-step guide to generating daily pips with it. I will be showing you 3 different strategies you can trade with the Ichimoku indicator, so be sure to watch this video till the end. Sounds good? Then go ahead to smash that like button and subscribe to this channel. I would really appreciate it as it helps the channel to grow. We also do a giveaway for each video, and if you are keen to enter yourself into the giveaway, then check out the pinned message in the comment section for the instructions. Now, in case you haven't heard of the Ichimoku, it is a trend following indicator that functions very much like a moving average, except that it is much more potent than the typical moving average. While the moving average can be used as a dynamic support and resistance level, it only provides a single level, unlike the Ichimoku, which provides a zone. And if you are new to this channel, I always stress that support and resistance levels are never a single level. Additionally, the Ichimoku indicator also provides different support and resistance levels for short-term and medium-term trading. In my opinion, this is what makes the Ichimoku really powerful. I will show you how you can use it as short-term and medium-term support and resistance next, so keep watching. First, we have the Tenkan-sen, or otherwise known as the turning or conversion line. It is a short-term line that pinpoints minor support or resistance. You can use this line as a form of reference if you are into scalping or any short-term trading. Next, we have the base line, which is otherwise known as the confirmation line. This line can be used as support or resistance for the medium term. You can also use this line to throw your stops and exit your positions, just like a normal moving average. Then there is the lagging span, which is otherwise known as the lagging line. This line is typically used as a confirmation of signals, though it can also pinpoint support and resistance. And lastly, we have the Kumo cloud, which I have previously touched on in one of my previous videos. If you forget anything that I mentioned about the Ichimoku indicator, that's fine, but not this one. The Kumo cloud is probably the most important aspect of the Ichimoku indicator. Now, this cloud is formed by 2 lines, which are called span A and span B, and it demarcates the area of dynamic support and resistance. For this video, I will not go into the calculations about how these values are determined. What is more important is understanding how to use it and testing it for yourself. But if that is something you like to understand, do leave a comment below to let me know so that I can create a separate video talking about how the different component values are calculated. Now that you understand the different components, here comes the interesting part: how to interpret the Ichimoku indicator correctly. Be sure to pay close attention to this part of the video because many traders get this wrong and lose money by applying it wrongly. I don't want that to happen to you, so pay close attention. The first thing you want to understand is the conversion line, which measures the short-term momentum. If the price is trading above the line, then you can conclude that the short-term trend is bullish. Conversely, if the price is trading below the line, you can conclude that the short-term trend is bearish. Now let's talk about the baseline, which represents the medium term. It functions similarly to the conversion line. When the price is above the baseline, you can conclude that the medium-term trend is bullish. And when price is below the baseline, you can conclude that the medium-term trend is bearish. The only difference between the baseline and the conversion line is the time frame. One shows the short term and the other shows the medium term. Moving on to the lagging span, this line shows you the overview of the trend. When you see that the lagging span is above price, that indicates a bullish bias. And when you see that the lagging span is below price, that indicates a bearish bias. Sometimes you will see that the lagging span is flirting around the price. This isn't a sign that the market is flipping between bullish and bearish. Rather, that's a sign that the market is in a range and price is consolidating. We are finally down to the Kumo cloud, which is plotted as a cloud. Earlier, I mentioned that it functions as a dynamic support and resistance, but I didn't explain how to interpret it correctly. When price is above the Kumo cloud, that's a bullish trend. The longer price stays above the cloud, the more established the trend is. So if you see that price has been staying above the cloud for quite some time, then you want to avoid selling and trading against the trend. Another thing to note is the cloud's width formed by the two lines, span A and B. The wider the cloud, the stronger the support or resistance level. If you see a thin cloud, that's a weak support or resistance level which you might want to avoid trading off. Because the Kumo cloud is a zone of support and resistance, you want to avoid trading in the Kumo cloud where price might consolidate. If you see price dipping into the Kumo cloud, wait patiently for price to exit the cloud first before taking a position. Now that you have a comprehensive understanding of the Ichimoku indicator, I want to show you 3 trading strategies that you can implement with the indicator. I know this is the part that everyone is excited about, so keep watching because I will show you how to translate the theory into practical step-by-step trading strategies that you can implement and test today. Here's a gentle reminder that the Ichimoku is a trend following indicator, so you want to avoid using these strategies during a ranging market. The first strategy is a crossover strategy, which focuses on the baseline and conversion line crossing over. We will also be using the lagging span to help us filter out the trades. You can think of it like your typical moving average crossover strategy where a trading signal is generated when one moving average crosses over another moving average. When the fast-moving conversion line crosses above the slow-moving baseline, that is a bullish crossover and a buy signal. And when the fast-moving conversion line crosses below the slow-moving baseline, that is a bearish crossover and a sell signal. But wait, remember we need to apply the lagging span to filter the signals. So if you see the lagging span is above price and there's a bullish crossover, you can then proceed to buy. Similarly, for a bearish case, you want to see the lagging span below price and a bearish crossover. Let me show you some examples of this first strategy. Here we see that there is a bullish crossover and the lagging span is above price. Our entry, stop loss, and take profit would look something like this. Over here, we have a bearish crossover and we confirm that this signal is good because the lagging span is below price. Here's how your entry, stop loss, and take profit might look like. Now let's move on to the second strategy, which is a slight variation of the first strategy. Rather than filtering out the signals using the lagging span, we use the Kumo cloud instead. This is my favorite and I prefer this strategy because sometimes you might find yourself shorting into a cloud of support or buying into a cloud of resistance if you are not careful. This strategy ensures that it doesn't happen to you, so keep watching to learn how to avoid this issue. Do remember that price must exit out of the cloud before taking any positions. When there is a bullish crossover, meaning to say that the fast-moving conversion line goes above the slow-moving baseline and we see that price above the cloud, that is a good bullish signal. We want to avoid bullish signals if price is below the cloud, since the cloud can act as dynamic resistance and hinder our trade. Conversely, when there is a bearish crossover and price is below the cloud, this is a good bearish signal. We also want to avoid the bearish signals if price is above the cloud, since the cloud can act as dynamic support and hinder our trades. Here are two examples to illustrate this strategy. Here we have price above the cloud and a bullish crossover. Your entry, stop loss and take profit target might look something like this. And over here, we have price below the cloud and a bearish crossover. This is how your entry, stop loss and take profit might look like. Now let's move on to the last trading strategy that involves trading the Kumo scout breakout. As the name suggests, you want to be trading when price breaks through the Kumo cloud. When price pulls back to the Kumo cloud, two things can happen. Price can either bounce off the level or break through. In a bullish setup, we want to see price enter the Kumo cloud and break the upper line. In a bearish setup, you want to see price enter the Kumo cloud and break the lower line. Let me show you two examples to help you better visualize this. Here, price enters into the Kumo cloud and eventually breaks it. This candle is the breakout candle and will be our entry candle. You can set in the stop loss and take profit, something like this. Here's a bearish example where price starts declining and eventually breaks the Kumo cloud. This is the breakout candle and the candle that we will use to enter when the candle closes. You can set in the stop loss and take profit, which will look something like this. So hopefully this is clear. Summing up this video, the Ichimoku indicator is a trend following indicator that has the fast moving conversion line, the slow moving baseline, the lagging line, and the Kumo cloud. We can trade the Ichimoku in three ways: the crossover with lagging span filter, the crossover with Kumo cloud filter, and the Kumo cloud breakout. My advice would be to choose one of these strategies, backtest it and start demo trading with it. Do not overwhelm yourself by trying to master all three strategies at once. And that's all I have for you in this video. I hope you got value. Remember to like this video, subscribe to the channel and comment with the emoji plus Forex signals to enter yourself into our giveaway. The winner will be announced in the next video. So turn on the notification bell and check to see if you have won. If you are currently holding a day job and want a strategy that doesn't require you to stare at the screen all day, I recommend that you watch this video next because it will show you how to set alerts. Thanks for watching. I'll catch you in my next video.